So what is the cost of capital? Can you read?
The cost of funds used for financing a business. Cost of capital depends on the mode of financing used. It refers to the cost of equity if the business is financed solely through equity, or to the cost of debt if it is financed solely from equity.
आपको दिक्कत हो रही देखने में? अच्छा. So you can just read it from your slide also. Okay. Is it okay? This doesn't require any explanation. So let's just go back. Okay. Just read this.
Many companies use a combination of debt and equity to finance their businesses, and for such companies, their overall cost of capital is derived from a weighted average of all capital sources, widely known as the weighted average cost of capital.
Now, it is called popular, it's called WACC. WACC. Weighted average cost of capital. Okay. So if you look at this example, suppose the company has raised money through equity share capital, bank loans or bonds, and the total capital was 2,300 crores. 65% of the money is equity and 35% is from loan. Suppose the cost is given to you, and we'll understand now. Our job is to understand how this cost has been worked. Okay, so we'll understand that. Suppose the cost is given, 15% is cost of equity and 10% is the cost of loan. So we just calculate the weighted average cost as 13.5%. By multiplying with the weight into the cost, we get 10% as the share capital cost and 3.5% WACC. Is that okay? So here we have assumed the tax rate as 0. Fine. So I have not brought the tax angle here. So in next this thing, we bring the tax angle also. So what was the cost of capital? This thing 13.5%. But when we talk about and say the company has to pay any tax also, every company has to pay tax. Suppose the company tax rate was 30%. The cost of capital comes to 12.5%. So it has dropped by 1 percentage point because the debt is tax deductible. So whenever company has taken a loan, company has to pay interest. Interest is an expense for the company. Okay. And before paying any taxes, the company will get interest as a cost benefit, this thing, and they have to pay tax less. Okay, they'll get a higher tax deduction because the interest becomes a cost for the company. Okay, whereas when the company raises money through share capital, it has to pay dividend, and you can even skip the dividend. Suppose it pays dividend. Dividend is just an appropriation of profit. It's not a cost. So for dividend, the company is not going to get a tax benefit. For interest, the company is going to get a tax benefit. So which means the cost of equity was 15%, so it will remain the same because even if the company pays dividend, it will not be tax deductible. When the company pays loan, which was at 10% in my previous slide, so 1 minus T, 30% tax rate, so 10 into 0.7, so it comes to 7%. So the cost will be only 7% to the company. By 30% the tax rate, 10% is the rate on which they are going to pay to the bank 10%, but actual cost to the company will be only 7% because 30% their tax liability will get reduced because of that. Okay. ये क्या है? नीचे लिखा हुआ ना 10% is the cost of debt, isn't it? 1 minus T. T is how much? 30%. Assume the tax rate is 30%. So 1 minus T becomes 0.70. So 0.70 into 0.10 or 70% of 10% is 7%. We'll understand all this when we do little bit further. Okay. So interest is a tax deductible expenditure for the company. Okay. Let me just show you one more. Okay, look at this slide. So this is, the slide number 92. Okay, go to the slide number 92. Tax effects on financing with debt. Suppose you assume the profit of the company is 4 lakh. Okay, so there is one company which has only equity, another company has debt. Fine. So assume that two companies, one is having only equity, no debt. The other company is having uh, a debt also. Okay. Now suppose they are paying interest. Okay. Second company is paying interest. First company is not paying. So their earning before tax will now go as 4 lakh and 3.5 lakhs. Is that okay? The first company doesn't have to pay any interest. Okay. Second company has to pay interest. Okay. So which means, tax will be 34. Suppose assume that rate of tax is 34%. So tax will be 1,36,000. The tax here will be 1,19,000. Because the company's profit has gone down, the company has paid, interest. The first company has not paid any interest. The tax liability is 1,36,000. Whereas the second company has paid interest. So their tax liability is how much? 1,19,000. Is that okay? हाँ अभी तो नीचे चलने दो अभी. Let me just finish this thing. Then only you will get this thing. So what will the profit after tax? 2,64,000 and 2,31,000. First, understand up to this level. Have you understood? Is this clear to everyone? Is this clear to everyone? Now, suppose the first company has paid dividends. Okay, just to make it apple to apple comparison, I have kept 50,000 rupees as dividend, which is equivalent to the interest rate, just to make apple to apple comparison. Okay, now what happens? The company has, if it has paid dividends, so what will be what will go to the reserves and surpluses? 2,14,000. But here, what will go to the reserves and surpluses? 2,31,000. So which company is showing more profits? B with debt, because debt is cheaper. Whereas here they're not going to get any tax benefit. Now the difference is how much? 17,000. And this is exactly, the interest cost is only 33,000. So 17,000 which we have got benefit, that is reflecting in the profit difference. Have you got it? Have you understood? Is there any doubt? आपका क्वेश्चन हो गया सॉल्व? 4 lakh minus 1,36,000, 2,64,000. 4 lakh minus 1,37,000, 2,64,000. Now, at that level, we are finding the firm with equity is better. But when we go further, and if the company has declared dividend, just to make apple to apple comparison, because both the companies are incurring cost. Suppose similar cost, 50,000 is dividend. Okay. Now, this means the retained profit of the company, second profit will be greater than the first profit company, because it is saving 17,000 rupees tax, because the interest is tax deductible. Is that okay? ओके यहाँ तक हो गया था. ओके. हाँ. No. That example was given to show you that tax interest is tax deductible. That's all. That purpose was only that. Now, whenever any company is taking capital, okay, when it is, the shareholders putting their own money and a company is taking loan, so every company wants to become profitable, isn't it? Some company may lose all the capital because the company is into losses. Fine. Okay. But if you think company is going to generate profits and it is going to be very good, then you assume that you should take some amount of debt also, because it will improve your profitability, because it's going to magnify the returns of the company. Okay. Fine. The example में तो ये सिर्फ only concept was the interest is tax deductible and you get a benefit, because if you raise money through debt, it is much cheaper than when you raise the money through equity. Okay, fine. That was just to prove that point. So equity is much cheaper and the equity is much costlier compared to debt. Okay, but excessive use of debt the company can become leads to bankruptcy if it is unable to pay. So company becomes riskier, isn't it? If the company becomes more riskier and riskier, it takes more and more loan. First of all, it has to service the debt. Then the people who are going to give equity to the company, they will also not give. So they will demand higher premium. So cost of equity will go up for those companies which take more debt. Fine. So whatever advantage you may get by taking more debt can be nullified because the shareholders will demand a higher risk premium. So the cost of overall weighted average cost of capital may go up. So we're going to discuss that only in our coming slides. Okay. Is that okay? Just read this.
Many companies use a combination of debt and equity to finance their businesses, and for such companies, their overall cost of capital is derived from a weighted average of all capital sources, widely known as the weighted average cost of capital. Since the cost of capital represents a hurdle rate that a company must overcome before it can generate value, it is extensively used in the capital budgeting process to determine whether the company should proceed with the project.
Does it require any explanation? Just read it yourself in mind, and if you have a doubt, please ask question. Otherwise, I'll move to the next slide. Anything which you have not followed, you may ask. Even if for one word you have not followed, please ask me. I'll just explain. वो अभी करेंगे ना अभी तो we have not reached to it is right at the end today. By the time when we close the lecture, we'll be calculating the WACC of various companies. Okay, but have you understood what is written on the screen? Is there anything which you have not followed? Okay, fine. So let's first of all understand cost of equity. So first we'll understand cost of equity, then cost of preference shares, cost of debt, and then we'll calculate the weighted average cost of capital for any company you want. We can calculate. Okay, and there will be a lot of examples in my coming slides. Is that okay? It's an hurdle rate basically. For example, if you say my cost of capital, when we are using capital budgeting techniques, when we are calculating the net present value or IRR, so we use the cost of debt, okay, to discount the cash flows. And then if we got a positive number, we said, okay, we should go ahead and do the project. So that's a hurdle rate. So we have to cross that hurdle. Fine. So when we, in the example which we did in the morning, where we got some 2,000 rupees positive, after discounting the cash flows at the cost of capital with nothing but the hurdle rate. So we got a positive. Suppose it is hurdle. Suppose we would have got a negative figure, which was a hurdle. So that means we will not be able to do that project. So it's a hurdle rate. हर्डल है ना, बीच में हर्डल है वो. अगर आपने हर्डल क्रॉस कर लिया और आपका एनपीवी पॉजिटिव आ जाता है या आईआरआर क्रॉसेस the cost of capital, we said okay, we should do the business, otherwise we'll not do that project. Fine, it's a hurdle. Is that okay? So keep asking, that's a good question. Okay, cost of equity. So let's understand the cost of equity.
It is difficult to estimate because it is an implicit cost.
Remember, it's an implicit cost. Because there is no cost. We don't tell the shareholders we will giving you 15% dividend or 20% dividend. It may be announced after the company has earned the profit. Okay, but when the company is raising capital, it can't, guarantee a kind of a dividend rate to the shareholders, isn't it? Fine. So cost of capital, and again, it's not only the dividend which becomes the cost of the capital, because the cost of capital would be much greater than the dividend. Company may be paying only 10% of the profit as dividend. Fine. Rest of the money also belongs to the shareholders, isn't it? So that is the expectation of the shareholders. So it is difficult to estimate because it is an implicit cost. First of all, it is an implicit cost. So it's the most difficult thing to calculate the cost of equity. It's not so easy. Okay. But then how do we do that?
The cost of equity is what investors in the equity in a business expect to make on their investment.
Now, if, whenever we are investing some money, we always want that what kind of a return we'll be getting, isn't it? Each one of you, when you invest, the second question you ask is, how much money, or the first question you ask is, how much return I'll be getting, isn't it? Fine. If you're putting your money in a fixed deposit, it more or less, it will be the current rate of interest, which is around 7.5%. Okay. Senior citizen may get 0.5% more. But we know that, for bank, the cost is 7.5%. For me, the return is 7.5%. Isn't it? Fine. For bank, it is a cost. So here we are looking from the company's point of view, which is in the case of bank, the cost of fixed deposit is 7.5%, which is the current rate of interest at which they are going to pay to the to the people who are depositing money with the bank. Now, When you invest the money in a business, okay, then it all depends what is your kind of a return do you expect. Normally, normally, I may ask each one of you, suppose you are putting in a business some money, some business with, I mean, don't think about any kind of a, think about any business in your mind and say that I'm going to invest in that. How much return do you expect from the business? आप जब पैसा लगाएंगे, what's the kind of return you should get every year when you're doing a business? Huh? 10 to 15%. Very good. Because you will always expect, higher than fixed deposit, because when you're doing business, it is riskier. So the answer is absolutely right. 10 to 15%. What would be your 15%?
Anything more than the cost or the interest that I am getting from the market, right?
No, I'm saying that suppose, forget, you're going to start your own business. आपने कोई business शुरू करा, so what kind of a return do you expect for
Cost
the?
of capital से ज़्यादा।
नहीं, cost of capital तो हमें पता ही नहीं ना, आपका अपना है, that is your own money.
तो उसमें भी अपने money
हाँ,
का
तो है, तो
interest
what is the cost of your own money? Tell me.
That's वही जो interest rate market में होती है।
हाँ, so more than 7.5% you're saying. So anything more than 7.5% you like to? So it should be around 9%, 10% or whatever. Okay. अब 7.5 है, suppose you get 8% return from your business. Will you be happy? Will you be happy? Your cost is 7.5%. Okay. Suppose you have taken a loan from the bank and for financing your business, and your cost is 7.5%. Suppose you get 8%. Will you put that money in your business? You're getting only 8% return.
Very less profit, obviously. Not enough to encourage.
So what should be the reasonable amount of money you should expect when you put money into business? Their answers are right, 10 to 15%. So I'll say 15% is, she said 15%, so 15% should look to be decent because it covers all the risk you're taking.
So I think इसका जो comparative होना चाहिए वो share market के साथ directly होना चाहिए.
Okay, just hold on.
Taking much effort.
Okay, just hold on. Okay, आप काफी सारा, you're doing a lot of analysis, so I'm just saying just a point bank number. Okay, don't make any analysis. Just say that what kind of interest rate. आप बताओ, चलो उनको जब तक calculate करने दो. हाँ? 15 to 20%. आपका 10 to 15%. So if I take a poll, yeah. So anybody who is getting a 15% return or thereabout would feel satisfied, isn't it? Fine. By हाँ जी, आप नहीं 20%, 25%. Okay. हाँ, so it will all depend. चलो let's look at how much Reliance earns for the shareholders. So let's go back to the business. Okay. So as he was saying, how we look at the market. Okay. Look at Reliance. So return on equity, how much? 8.94%, which is far less, isn't it? But let's look at, I'll just come to this, let's go to, say, for example, Asian Paints. हाँ, हीरो देख लेते हैं. Hero is how much earning? This is exactly matching with your requirement, isn't it? 16.7%. ROE, return on equity. That means if you have given money to Hero, how much they are earning on the equity. Okay. Now here, let's look at the formula. Let's say understand the formula. So I just go to calculator. How it is calculated? Let's check. Of course, one is very simple fashion. We may not get the accurate number, but we go to the accurate number also. So let's go to, for example, let's look at the profit of the company. Let's go to profit loss account. Okay. And just go to the net profit. How much is the net profit? Huh? 324. This is 3,240 crores. Okay. So I'm just going to copy this and put it here. 3240 डाल देते हैं इसमें. 3240. This is the profit. Okay. हाँ, एक जीरो कम कर दे, ज्यादा हो गया, ज्यादा प्रॉफिट का हमारी कंपनी में. Okay. And then I divide this by what? Equity share capital. Reserves and surpluses plus equity. So give me the number. Go to balance sheet and go to this number. Equity is 40, reserves is 17. So 17,670, something like that. Divided by 17,674. फाइन, ओके, जो भी है 18% आ गई, यू गेटिंग हाउ मच इन 200, so you're getting 18.33, and how much it was showing? Huh? 16. Okay, so let's do what's the difference. So a better, more accurate way would be to make an average of the opening capital and the closing capital. So यहाँ 16,000 है या 17,000 है, so 1,000 तो 500 कम हो जानी चाहिए कैपिटल. आपका ओपनिंग कैपिटल इतना था, क्लोजिंग इतना था, सो ऑन एन एवरेज कैपिटल वुड बी 500 करोड़ लेस, इजंट इट? सो आपका जो बेस होगा वो कम हो जाएगा, तो फिर आपका और बढ़ जाएगी, 18 से ज्यादा हो जाएगी. तो मे बी दैट वी शुड लुक एट द नेट प्रॉफिट. ओके, so look at the net profit, for example. Let's see, I'm just saying 18% आ रहा है, there नजदीक ही आ रहा है. So let's go to the this thing number and go to net profit here. So net profit, profit after tax, profit for reported minority share, profit for P ratio. Okay, fine. So maybe this is the TTM number. Let's say 2,800. Fine. क्योंकि अभी टीटीएम नंबर है, टीटीएम नंबर ट्रेलिंग 12 नंबर्स, तो अभी अप्रैल में जून है. अगर हम 31 मार्च 2023 का निकालेंगे तो इट विल बी अराउंड, बिकॉज इट वाज लेस प्रॉफिट, सो इट विल कम डाउन टू 16%. ओके, सो मे बी दैट यू यूज, दे आर नॉट अपडेटेड इट, सो आई एम सेइंग it's around 17 to 18%. Is that okay? So we're not matching the, the return now. We're not matching the ROE. ROE is 16.1%. That means, Hero MotoCorp is earning 16.7. Let's look at, for example, company like Asian Paints. How much Asian Paint is giving return to the shareholders? 27.7%. Fine. So it varies from company to company. Now Reliance is just giving 9%, but it has a great future, so that's why people are investing. Otherwise 9% is not very good enough, because if you deposit the money in a fixed deposit you get 7.5%, but you get 9% only in Reliance, so you should not be satisfied, isn't it? That's why you see that last 1 year Reliance has not done a great job. Okay, let's look at, for example, Reliance. Let's go back to Reliance. So if you look at Reliance, in the last 1 year, they have not, though the analysts are saying go and buy Reliance, it's going to give you around 15% return over the next years, next 10 years. Okay, but Reliance has not done justice, because it is generating only 8.94% return for the shareholders, isn't it? But looking at the future prospects of Reliance, okay, how they are expanding their businesses, so you always look at how much they will be earning in future. This is a historical number, isn't it? ये तो historical number है, ये तो हो गया. Fine. So they have made a lot of investments in the last couple of years. So maybe that they will start yielding more returns as we go along. So we'll understand that process also. Okay, fine. How do we look at the future of the company? That's the next process. Let's go back to our किस चीज का return on equity. It is the net profit by the shareholders' equity. That means your equity plus reserves, both. So shareholders' capital, the retained profits or reserves plus the original share capital. Is that okay? Fine. Okay. वो भी exercise करेंगे हम बाद में. Maybe if time permit, because the course is going to finish. It's not, we are going to do not much of it. So this is okay. Read further.
The rate of return required by equity investors on an investment, it will incorporate a premium for equity risk. The greater the risk, the greater the premium. The cost of equity should be higher for riskier investments and lower for safer investments.
So which means, when I asked the question, how much do you expect when you put up money in a business? So each response was different. Now, you said around 15%, and that gentleman, what's your name? Huh? So he said around 25%. So, maybe that in his mind, he has in mind that he's going to get 25% return. But even if the business is riskier, the business which is more riskier will give you that return. Okay. जो business ज़्यादा risky है, that may give. Like for example, a business of a company called Mercedes, like who's making Mercedes. Okay. Suppose, what is the name of the company? I don't remember. Suppose the company is making Mercedes. So their business is more riskier, but they make huge amount of profits. When the business going good, they earn a higher, margins from the customers and they return. But at times the sales of Mercedes drops when the whole business is not in good shape. Like, for example, take, Land Rover and Jaguar in England. The company is owned by Tata Motors, but their profitability keeps going up and down depending upon the fortunes of the economy. Now, whole of the Europe is in bad shape. So, those Tata Motors arm, which is Jaguar and Land Rover, is not doing very well in Europe. Okay, so when they earn profit, they reward, at a high returns to the shareholders. Okay, is that okay? Okay, read further.
The cost of equity is the return required by equity investors given the risk of the cash flows from the firm.
Okay, is it clear? It depends on how much return the company is going to give you, or how much cash it is going to generate. Fine. How much cash flows it is going to generate. We talk about cash flows. Don't talk about profit of the company, because the profits are, accounting concept. It's an accrual concept. If I say I made a profit of 1 crore, suppose it includes 1 crore of sale done just, yesterday, but I haven't not received money from my customer. So if I say I have made a profit of 1 crore, I may not have that much of cash to support that, because I'll get cash only after 3 months when the customer pays. So we talk about cash flow rather than the profit. Okay, fine. So the cash is king. So we always say how much cash the company generates. Now, every sale of the company, whether done on credit or cash, if it is done on credit, it generates cash in times to come. Okay, so we talk about cash flows and not talk about the profit of the company. Okay, so it depends upon what? It depends upon business risk. How risky is the business? How risky is the business itself? Some businesses are risky, some businesses are not less risky. Okay, as I explained earlier. Then the financial risk, how much loan you have taken, how much leverage you are. Okay. Now, if the business is riskier and you have taken more loans, so the whole, business becomes riskier, isn't it? आपका बिजनेस वैसे रिस्की है, आपने और काफी सारा लोन ले लिया है, तो बिजनेस रिस्क बढ़ता चला जाता है by taking more and more leverage. Is that okay? Now, risk. So let's understand what is a risk actually.
It refers to the risk associated with the firm's operations. It is the uncertainty about the future operating income, that is, how well can the operating income be predicted.
Okay.
Financial risk, it refers to the additional risk placed on the firm's shareholders because of use of debt. That is the additional risk a shareholder
सोडा नहीं है,
bears.
पानी है. He's looking at me. It's water. Earlier, I used to carry a big this thing. वो अभी कम हो गई water की demand. So I carried a soda bottle. So, I remember it will get recorded. Okay, I'm resuming that. So no more soda. Okay. So it is basically the business risk and the financial, risk, which is because of the leverage. So I'm just skipping this slide, nothing more to add. Now, cost of equity. There are two major methods for determining the cost of equity. We are moving very slow, okay? Fine. But I want that we should move slow, but you should understand the whole concept, okay? Fine. इसकी बैटरी मेरे को लगता है जा रही है. Okay. Now we understood that the cost of equity will depend upon the shareholders' expectation. Now when I asked many people, everybody had a different this thing. She said 10 to 15%. She had 15%. What's her name? वो तो अभी undecided थे. So he wanted to do a lot of analysis before committing his number, and then he said 25%. So everybody has a different kind of a reply. What is expectation? When everybody has a different kind of a expectation, it is very difficult to calculate the cost of equity, isn't it? Every shareholder will have his own assessment of about a risk or of the return of any company. Fine. So how do we find then the because the cost of equity is nothing but the return expectation of the shareholders. But when there are so many shareholders, there are so many people having different kinds of expectations. So how do we, how do we calculate the cost of equity? So it becomes a more difficult job. So there are two major methods for determining cost of equity. So somebody has to say that, okay, we can still find it with so many people having divergent, expectation of a return, but can we still find it? So, there were two gentlemen or three gentlemen who came out with the reply, yes, we can find it. So let's understand. So one is called the dividend growth model, which was, maybe the oldest method, which was, Gordon Brown was the person who came out with this dividend growth model. Okay. Then, there is a CAPM model, capital asset pricing model. So there are two widely known models. One is called the dividend growth model. But, this gentleman, Gordon Brown, he assumed that dividend is only kind of a return which shareholders get. Okay. Fine. But, most of the companies don't pay dividend. Fine. Because they plow back the money into the business, so they skip the dividends. So because of this reason or because of many other reasons, so this model is good basically, but not the most appropriate model. So the CAPM model, which is called the capital asset pricing model, is the default model still today, but it has a lot of defects, lots of assumptions which are not very realistic. Okay. But nobody can challenge this model. So far, it has been challenged. It has been challenged. There are so many things which have come after that. It was, done by around 1950s or so. It was established by certain gentlemen like William Sharp and, other people. So they were all, creators of this model. So, but this model is very simple. It's so simple that people fancy for this model. Okay. And all other models which have come thereafter are either too complicated or it involves a lot of resources to calculate it. And you can always make mistakes also while calculating. So because of the ease of this model, so this model still remains the most widely used model, but lacks a lot of things. Okay, fine. So, but it gives you a fair idea. So let's understand. So a model, what is CAPM model? That model that describes the relationship between risk and expected return, and that is used for pricing of risky securities. So it's a model that describes the relationship between risk and expected return. Now, risk is what? The business, because doing business is risky, and if it gives you a return and risk model. Fine. So more risky, more return. Okay. So it's a model which basically tells you a risk and return kind of a settings. Okay. And it is used for pricing risky securities. That means this model was originally developed not only to calculate the cost of capital, but also ultimately to calculate what should be the price of a share of a company. Okay. So it's a very powerful model which not only calculates the cost of capital, but also is used for calculating what should be the share price of, say, Reliance or any company. What should be the ideal price of Reliance? Okay. Or what should be the fair price of Reliance? It is overvalued or undervalued, so it leads to that calculations also. So dividend ground model, I'm just skipping that at the moment because because time is very less. Otherwise, we always do for academic reasons or for our understanding. So we go to the CAPM approach, which is the most commonly being used. Okay. So there are many ways in which we can estimate the cost of equity for business. Second paragraph.
The most widely used method to determine the cost of equity is using a risk and return models,
So it's a mechanism through which it's a formula which uses risk and return. Okay.
which means we derive models that measure the risk in an investment and convert this risk measure into expected return, which in turn becomes the cost of equity for that investment.
Okay. So basically, क्या है? Depending on the risk of the business, it tells you how much return you can expect. Now, he was expecting 25% return. So that means the business would be more riskier to generate the higher return. She was expecting 10% return. That means the business was less risky and she was satisfied with 10%. Maybe she said 15 also. So now the return expectation also becomes the cost of capital for the company, isn't it? So last line, it becomes the cost of equity for that investment. For company, it's a cost. For us, it's a return on investment. Is it?
capital asset pricing model, arbitrage pricing model, multi-factor model?
So there are, couple of models which have been given. Of course, there are a couple of more models which are there in the world. Okay, I just put three. So capital asset pricing model, which is called CAPM, which we are going to use and understand. Okay, but there is something called arbitrage pricing model. Now, whatever simple assumptions which were there in the capital asset pricing model, which is called the CAPM, so they were relaxed in arbitrage pricing model. So it became more realistic model. So somebody wanted to make it more realistic. He said the second model is better than originally which was given by CAPM. Then there is yet another model which is called multi-factor model. So that means there are many factors on which the cost of capital is there. It's not only one factor; it can be many factors. Okay, but again, the CAPM model is also based on many factors, but only there is one risk parameter which has been. So we'll understand that, and let's understand how the multi-factor model is much better than the CAPM. But because of complicated way to calculate it, okay, that's why those models have not taken off so much. Okay, fine. So CAPM still is the default model for measuring the market risk in finance. Okay, fine. So this is the most important model which has been used for measuring the market risk in finance. So CAPM approach. So let's understand the formula. So the formula is cost of equity. Now the formula is on your screen. So the cost of equity, which is called KE, we write K and a small letter which is under the K. KE is cost of equity is equal to RF. RF is the risk-free rate. That means without taking any risk, how much you can earn. By putting your money in a company, you're taking risk. So if you don't have to take any risk at all, where will you be putting your money? In a fixed deposit or in a government bond? A government bond is less riskier than even the fixed deposit, isn't it? Now you get 7.5% return on a fixed deposit, but if you look at the risk-free return, okay, that's around 7.3% as of today. If you go and check what is the rate at which you can, invest your money in a government bond, it is giving 7.3%. Okay, fine. We'll go and check that. So RF is the rate of return which the government is going to give you if you deposit in a government bond. Okay, fine. So now you since you are putting your money in an equity, so you should get something more. You should get plus, isn't it? So plus, because you're not putting in a government bond, ये तो मिलना चाहिए this much, so you should get minimum. After that, you should get what? Plus the beta. The beta is the risk of the company. Each company will have its own beta, and we're going to understand what is beta. So beta is a measure of risk of that company. Within bracket, RM minus RF. RM is the average return if you put your money in a market. Okay, market return. Okay, when we say RM, that means how much return which you are getting by putting, by giving your money to all the companies, say in India, for example. RM is the average return by investing in Indian stock market. If I say bluntly, it is a return which you have given. If you look at the last 20 years return of the equity market, it's around 13%. How much it is? 13%. And if you look at the whole, right from, when the Sensex was, 100, okay, and today it's around 70,000. So if you calculate the return, it has given around 16% return. Okay. So let's calculate that first of all. So ये लास्ट टाइम मैंने आपको बताया था सेंसेक्स in 1979 it was formed, it was 100. Okay, and today as we speak it is 2023. Okay, it is say 70,500. आज सेंसेक्स 70,500 का. Either we can take Nifty, Sensex, or any index. So let's take Sensex, okay, which is a 30 share price, 30 shares of India, of covering all kind of industries. Okay, we can take even Nifty also. So how many years have gone by? 44 years. Okay. So if I put here, formula and calculate, say IRR. Is it IRR? No. It is return rate. So let's put rate. How much rate you have got? So NPR is how much? 44. So 44 years. And when you put your money, it was 100. So you gave, suppose you gave 100 rupees to someone and he has given you how much? 70,000 back. In how many years? इसको भी यहां डाल देते हैं ऐसे ही और माइनस कर देते हैं और ओके करते हैं. So how much return you have got? 100 rupees you invested in 1979, and in 2023 the Sensex is sitting at 70,500. In 44 years it has given 16%. So if you can make it a little bit. ब्रेक हो गया क्या? 11 बजे. So you got exactly 16% return, isn't it? दोबारा. Just listen. First I'll understand the formula and then ask me questions. So I go to formulas. I go to the rate. Fine. Rate आ गया. Okay. Then I use, I can just punch the numbers straight away. I can put 44 here. Okay. And present value में मैं -100 डाल दिया और फ्यूचर वैल्यू में मैंने 70,500 डाल दिया. यहां माइनस रखिए आप, क्योंकि 100 रुपए दिया और 70 मिले, तो 100 रुपए आपके पॉकेट से निकला और आपको वापस मिले 70,000 आफ्टर 44 years. So 16% रिटर्न आ गया. Is that okay? Okay, just hold on. I'll explain that to you. Don't worry. Now, suppose you would have put same 100 rupees in a fixed deposit. Okay. How much return you get on a fixed deposit? Around 7%, 7.5%, 8%, 6%. ऐसे ही चलता है. Let's say 7.5%. Right. So how much this money has grown from 100 to 70,000. This 1,000 rupees will grow at 7.5%. Okay. How much do you expect? How much should have 100 rupees become after 44 years? कितना हो सकता है? So I calculate future value. So NPR is how much? 44. I'm just calculating that. So let's put 100 here also. Okay. How much it comes to? It will belie all your hopes. 2,409. So 100 rupees put in a fixed deposit for 44 years will give you less than 2,500. Whereas putting the same money in equity market has given you 70,500 rupees. So somebody thought fixed deposit is safer and Sensex is riskier, but actually it turns out the other way around, that the equity markets are much safer, but for long period. हाँ, नहीं, ये आपको पैसा मिला तो नहीं ना, ये आपने 100 रुपए डाला था और एंड में जाके 70,500 मिला. सो योर मनी वाज गेटिंग मल्टीप्लाइड. So here the IRR assumption holds. It's not like every year getting some money. Assume that you have actually put your money 100 and it has become 70,400. Then the formula of IRR or whatever formula we are calculating, so this tells you the story that if you have a long-term horizon, equity is the best. It is actually the fixed deposit going to destroy the wealth. Whereas by putting money in a Sensex or the market, this is Sensex, okay? Fine. If you have chosen the best shares of the Sensex, you would have got even more than 16%. अगर आपका पैसा अच्छी शेयर में 30 शेयर्स में से भी 15 शेयर में लगा होता, which has given you a better rate. So return is 16% is the average return of all 30. Fine. There are certain companies which have not given return more than 7%. For example, Tata Steel, it has given around 10% return, which is also part of the Sensex. So if you have not invested anything in Tata Steel, your return would have gone to 17 to 18% return. Okay, fine. But fine, you would have chosen, or you would have chosen a fund manager who's going to have put your money. He would have decided where to put the money. He would have got you around 18 to 19% return also. Is that okay? So, so RM is the average return, which we just calculated 16% return over the last 44 years. Fine. Okay. Now, but if you have to look at the last 20 years return, the census is given only 13% return. So we should be more tuned towards 13% return rather than 16% return. Okay, fine. And what is the RF? It's close to about 7% today. So 13 minus 7 is how much? 6. Okay. And 16 minus 7 is 9. Okay. Or 15 minus 7 is close to about 8, isn't it? So actually, I'll just show you. It's a 8% which is called RM minus RF. Currently, there is a expert in the world. He's an Indian. Okay, he's considered to be a valuation expert. Damodran, Ashwath Damodran. He, according to him, this RM minus RF, which is called the risk premium, is close to about 8.5% for India. For every country, there will be a different kind of a risk premium. So he calculates India's figure of RM minus RF close to about 8.5%. Okay, fine. And beta is, we can't understand beta very soon. So it can be either return on equity or you can expect a return. So it's both sides of coins. Okay, one is the cost of equity, and the side it's called the return to the equity investors. Fine. So you look at this number from two angles: one from the investor angle, another from the company's angle. So one becomes the cost, another becomes the return for the equity shareholders. Is that okay? A little bit more, and then we'll have. आपकी ब्रेक कितने बजे होती है? 11 बजे. Okay. Okay, little bit more. 5-10 मिनट और कर लेते हैं, then we'll have a break. And we'll have an early break and early finish. Okay, is that okay? Just read this.
The idea behind CPM is that
CAPM.
CAPM is that the investors need to be compensated in two ways: time value of money and risk.
So basically, it tells you that any investor should be getting a return. One should be based on the time value, which is basically something which beats the inflation, which is by putting your money in a fixed deposit or government bond. So that is time value of money. And second is the risk, by looking at the beta of the stock. And going back to the formula here, so this says this is the risk-free premium, and depending upon the risk of the company, okay, it will give you the cost of equity of the company. More riskier, so suppose this is coming 8, suppose this is coming say 1.5, suppose for example, okay, so this will become 12. 12 plus 7 becomes close to about 19% as cost of equity. अगर ये 0.5 होता तो क्या होती कॉस्ट ऑफ इक्विटी? 8 का आधा 4, 4 plus RF close to about 7 to 11%. Fine. So this we'll put these numbers as we understand further. Okay, how we have arrived. So how I have said B is either 1.5 or 1 or 0.5. Okay, we're going to talk about that more in detail at this thing. So basically, it is the time value of money, which is nothing but the RF. If you don't want to make any money except you have to want to beat the inflation, put your money in a government bond. Is that okay? Or fixed deposit. Other half the formula tells you about the risk of the company as well as the average return. Okay, so I'm just skipping this. Now, assumptions underlying the CAPM. Now, we say that the CAPM model is, weak. It has, it's not a foolproof model. Fine. It's not the, most ideal model. So what are the assumptions which are there? Why we are criticizing this model, which is, we say that it lacks this thing. So let's understand that. So these are the assumptions. Read.
Investors are expected to make decisions based solely on risk-return assessments. Investors have no access to private information, allowing them to find undervalued or overvalued stocks. There is perfect competition No single investor can influence prices with no transactions costs involved. Personal income taxation is assumed to be zero.
So here, there are certain assumptions. We say that everybody puts the money solely because of risk and return. Okay. No other. 99% will say that, okay, we invest. But there will be 1% people will say, no, it's not just risk and return. It can be something else. Okay. And then investors don't have any information to check. So he can't know, what is happening. So there is no private source to understand, whether how good is, Hero is doing. Now, people in your company who's in the finance department or CFO, he knows about, how the company is going to do next 6 months. But we all don't know. So we don't have any private information till it becomes information which is known in the public domain with the results are announced. Okay. There is a perfect competition. Nobody can influence the prices. Okay, but we have seen in past there have been a lot of scandals, a lot of things people can influence. Okay, but as the markets are growing, it has become very difficult to manipulate the markets. Okay, because the government has come up with a lot of transparency and a lot of rules, regulations, which nobody can manage the markets. Okay, so the CAPM was developed in the late 1950s. So that time there was a lot of scope of manipulating the market. But you think there's no way people can influence the market. Then there is no income tax. Personal income tax high in zero hai. This is also unrealistic assumption. Okay, fine. So let's see what are the shortcomings. Let's finish the shortcoming that will end it.
There are some limitations to the CAPM, such as making unrealistic assumptions and relying on a limited interpretation of risk versus return.
Okay, just hold on. So it says that there's a linear relationship between risk. जैसे जैसे रिस्क बढ़ता जाएगा रिटर्न बढ़ती आएगी तो वी आर assuming that there's a linear relationship. Okay, but how far that is practical, we don't know. Sometimes the risk goes up. It may not, lead to more returns. It may lead to a negative impact. Okay, next. This slide.
Despite its issues, the CAPM formula is still widely used because it is simple and allows for easy comparisons of investment alternatives.
Next.
Estimation of beta with historical data is unrealistic.
Now, there's a one very important number which is beta, which we are going to understand. Have you ever, heard about beta? Any course in which you have, discussed about beta? यहाँ जो कोई course में beta नहीं है. This is your first year or second year?
First year.
First year. Which semester? First few semesters or second. फिर तो ठीक है. Otherwise, if I ask this question in the second semester, the end, and the answer would have been you have not heard about beta, then I would have left the college, saying sorry, I can't teach you.
This will end up second semester.
And okay, still it is not very good thing. That still so far you have not heard this word. Okay, because the so important number, we'll talk about that. Okay, estimation of beta with historical data is unrealistic. Now, we are going to discuss how to calculate that risk of a company, which is nothing but beta, and how do we calculate by using historical data. Okay,